Thank you for joining us. This is Business Incorporated on Channels Television. I'm Chimeze Obi Iwabu. Coming up on the show, Nigeria's unemployment rate rises to 27.1% in the second quarter of 2020. Youth unemployment remains the highest. World Bank and IFC light up Ghana, bring renewable off-grid energy to communities. And Egypt's central bank keeps main interest rates steady. We start off here in Nigeria with the unemployment data released this morning by the National Bureau of Statistics. The data shows that unemployment rate grew by 27.1% in the second quarter of 2020 from 23.1% in the third quarter of 2018. Underemployment rate also settled higher at 28.6% in the second quarter from 20.1% in the third quarter of 2018. Unemployment rate among young people also rose to 34.9% from 29.1% recorded in the third quarter of 2018. According to the MBS, only 116.87 million persons were economically active in the second quarter of 2020, 1.2% higher than the 115 million reported for the third quarter of 2018. The latest data is coming 2 years after the last figures were released in 2018. And to intraday numbers now here in Africa, South Africa's JSE index lost the most by 0.67%, while Nigeria's main index declined 0.19% at intraday. Egypt's EGX30 closed the week positive on Thursday by 0.20%. Kenya ended Thursday's session negative. And in the Middle East, major markets ended the week positive on Thursday, with Dubai's index jumping 1.90%, while the Abu Dhabi index rose 0.62%. Elsewhere in the region, Saudi Arabia's benchmark index climbed 0.77%, while the Qatari index was higher by 0.52%. In Europe, markets traded lower on Friday morning as investors monitored concerns over a second wave of coronavirus cases and awaited second quarter Eurozone GDP growth estimates and, of course, other data. Let's talk to Annette Wisbert for details from the European space. Hello, Annette. Good afternoon. Well, we've seen some mixed economic data today and disappointing retail sales in China. What does this tell us about the recovery?
Well, the retail sales in China were really disappointing. Everybody had hoped for at least a flatlining there, but they came out as a minus 1.1% for the month of July. That also tells you the story that consumers are still reluctant and they don't really know how their economic future looks like, and that's why people are not shopping as much as before the crisis. Retail sales in China, the last time, were positive back in December, just before the outbreak of the corona crisis in the country. But if you look at certain patches, it's quite interesting because the high-end luxury goods are actually working quite well. So jewelry sales are up. Also, luxury car makers do have a good time already again in China. The likes of Daimler, for example, did say that they are seeing an uptick in demand. And that's also what we're hearing from the statistics office today in China, that especially the luxury product markets are seeing signs of revival.
They're on the rise again. What's the latest from Europe?
I don't hear you anymore. I'm very sorry.
Hello, Annette? Well, I guess we'll get back to Annette as soon as we're able to connect back. It's one of those days that technology can actually disappoint. Okay, let's look at the Asian market. That market traded mostly higher on Friday, but investors remain cautious after U.S. lawmakers seemed unable to move forward with a coronavirus stimulus bill. Australia's ASX 200 rose 0.58% to 6,126 points, with most sectors notching again. In Japan, the Nikkei 225 added 0.17% to 23,289.36, while the Topix index gave up earlier gains to finish near flat at 1,623.38. All right, I guess we have Annette back on board. Annette, yes, I was asking, COVID-19 cases are on the rise again. What's the latest from Europe?
Yeah, actually, with the travel season now being in full swing, if you want to call it travel season, but people are going abroad, and especially to the ex-Yugoslavian states like Serbia, Kosovo, but also Croatia, and they bring back the virus into countries where they live. So the situation is by far not under control. We have corona cases rising almost everywhere. For example, Paris and Marseille are again classified as risk regions. There's a travel ban now just being put in place, of travel warning, I should say, not ban, for Croatia, from Austria, and the UK. Has a mandatory quarantine for people coming back from France and the Netherlands. So that gives you an idea of how bad the travel sector is going to be affected, because clearly with travel warnings in place, people have the right to cancel their bookings again and will do so most likely. And that is weighing also again on shares related to the travel industry.
Look for next week, and what's the focus for markets? Okay, let's go to the U.S. market, where futures retreated on Friday morning after the S&P 500 failed once again to reach its record high from February. Dow Jones Industrial Average futures were down 213 points, pointing to opening losses of around 210 points on Friday, while S&P 500 futures were also lower. On the flip side, Nasdaq 100 futures pointed to a positive open. The gyrations between gains and losses on Thursday came as tech shares outperformed, while names that will benefit from the economy reopening struggled. Okay, Annette, back to you. Was asking the outlook for next week and what's the focus for markets?
Yeah, it's interesting because clearly the U.S. bourses are close to record highs. Some are even at record highs. So the question is whether there's a lot of room still for being positive for U.S. stocks, given the uncertain outlook for the economy. We just got retail sales from the States, which were partly disappointing, partly beating estimates. So month on month, it was an increase of 1.2%, which was lower than expected, but excluding cars, it was actually better. So meaning probably people are shying away from like big ticket items, and but they are purchasing stuff. Also, when they are when parts of the country is still in lockdown or severely battered by the corona crisis. So next week there will also be economic data coming out from the United States. The Empire State Manufacturing Index, which is an interesting one. It tells us about the situation of the American industry, very highly watched also from the financial markets. Then we get selected PMIs here from the Eurozone, so also a sign of things are improving despite the rise of corona crisis cases, I should say. But most interestingly will also be over the weekend, there will be a meeting between the US and China, and they're going to talk about trade, the phase 1 deal. We haven't been speaking about that, but this is crucial as well once the virus is going to leave us or once we have a vaccination. So trade is back on the agenda.
All right, thank you very much, Annette, for your time. Enjoy the rest of the weekend. Okay, in the UK, the travel industry has warned that the new restrictions on travel to France is a devastating blow and will lead to job losses. Let's hear more from Juliana. Hello, Juliana. Good afternoon again. So how are the travel stocks doing at intraday after the French quarantine rules, and what's the general market sentiment?
Good afternoon. Well, not great at all. The sell-off that we were seeing at early trading has continued at intraday. In fact, we're seeing triple-digit losses. The all-share is down 2.02%. The FTSE 100 is down by 2.22%. And the FTSE 250 is down by 1.32%. In currencies, the pound is up on the dollar by 0.21%. Up on the euro by 0.30% and up on the Japanese yen by 0.01%. Just to update our viewers, what happened overnight here in the UK is that the British government added France, their closest European neighbour, to their quarantine list. So if you are in France and Malta, the Netherlands, Monaco, Turks and Caicos or Aruba, after 4 a.m. tomorrow morning, Saturday morning, you will have to quarantine here in the UK for 14 days. As you can imagine, this has caused mass devastation and does affect 500,000 British holidaymakers.
And Eurotunnel had warned customers hoping to beat the government's latest travel quarantine deadline not to just turn up at its terminal this Friday. How is that playing out?
Not great at all. It's a shame we can't show you the pictures, but there are chaotic scenes at the Charles de Gaulle train station. There are apparently 160,000 Brits trying to get back from France. Of course, as well, it's going to cost you a lot of money. 24 hours ago, it cost about £66 if you wanted to travel from Britain's Heathrow Airport into Paris. At the moment, it's about £500, and that's the equivalent of about 250,000 naira. A lot of the tour operators are complaining of having triple demand. P&O Cruises, for example, absolutely booked. They're asking you not to try and book there. The Channel Tunnel is absolutely booked. Also, the Eurostar, of course, as I said, is completely sold out. So it's increasingly worrying for these holiday makers because, of course, many of them may be on furlough. Many of them have already lost their jobs. To find out that they have to come home and self-isolate for 14 days isn't great. I've got to say as well, the response from France has been pretty telling. The Secretary of State for the European Affairs said that this is going to lead to reciprocal measures. They are not happy that Britain have decided to do this. We heard from the British Prime Minister Boris Johnson. We also heard from the Transport Secretary Grant Shapps. They said they had to do this. There was an increase in infection rates in France for up to 66%. And I've got to tell you now that Greece apparently is next on the list. So passengers or the travellers who are in that destination are also worried. And one other thing to mention as well, private jet charter. They're a company called Private Fly. It can cost you upwards of £1,000 to use them just to get from Paris. They said that they're seeing a triple demand in passengers who are absolutely desperate to get back home in time before that quarantine kicks in at 4 a.m. tomorrow morning.
And it's been an interesting week with UK economy sliding into recession. What's the outlook for next week?
Well, for next week, besides the fact that I'll be on a staycation with my family and I'll be missing you, Chimezie and Bissy and all the others, guys, in Lagos, we've got Brexit Talks. Brexit Talks is back on the agenda again. There'll be talks between Downing Street and Brussels in Belgium. We did hear yesterday, actually, from the chief Brexit negotiator, David Frost, who did say he believes a deal can be done with the EU in time for September. You know, the stock market did rally on that tweet that he sent out yesterday, but who knows? There's still so much to go through. And so there'll be, I'm sure, lots of sound bites there that you'll be discussing. On Thursday, we're now expecting that delayed half-year results from the Fraser Group. We discussed it on your show earlier in the week. Chimezie, Fraser Group is owned by the billionaire Mike Ashley. He's the owner of Sports Direct, pretty controversial character. This is the second time that they've delayed their full year results. So the markets are not happy about that. It's expected on Thursday. Will that happen? I'm not sure. Also as well, pretty important update from Persimmon. Persimmon is the second largest house builder in the UK. In Chancellor Rishi Sunak's statement delivered early last month, he did say that there is going to now be a tax break for first-time buyers. So it'll be interesting to see if anything that the Chancellor has said is going to be in his statement. That's all, Chimezie.
We'll watch out to see that. Well, I will miss you too, Juliana, but enjoy your holiday with your family. Looking forward to speaking to Simon.
Yes, I'm sure you will be.
And away from the market, the Central Bank of Egypt kept its main interest rate stable despite restricting inflation and an economy suffering from the coronavirus pandemic. The bank's Monetary Policy Committee left overnight rates unchanged since it preemptively lowered rates in March to support the economy during the pandemic. The lending rate was unchanged at 10.25% and the deposit rate at 9.25%. They are lowest since early 2016, before Egypt embarked on a 3-year IMF-backed economic reform program. The MPC expects inflation in the fourth quarter of 2020 to remain below the target's midpoint of 9%. We'll take a break, and when we come back, we'll switch our focus to South Africa and, of course, more. To stay with us. The World Bank and the International Finance Corporation are financing a $220 million project for energy and development access in Ghana, which is among the first bank-financed programs to focus on inclusive access to renewable energy through off-grid solar services and products. The project, which includes 5 pilot mini-grids that converted solar energy to electricity for isolated communities in islands in the Vok Lake and the Volta River, seeks to push for inclusivity. These 5 pilot mini-grids provide 24-hour electricity to about 10,000 beneficiaries for the first time, allowing these fishing communities to use electricity to improve their livelihoods. The International Development Association is providing technical assistance to help make more mini-grids financially sustainable for homes and communities, with the support in regulation from the Ministry of Energy, Energy Commission, and the Public Utility Regulatory Commission. And key South African data released this week suggests an economic contraction in the second quarter as the damage brought by a nationwide lockdown to curb the spread of the coronavirus pandemic becomes clear. Manufacturing production, mining output, and retail sales plunged in the 3 months through June. Joining me now to talk a bit more about this is the Chief Investment Officer at Marcilla Fund Managers in South Africa, Marcilla. Thank you very much for joining us, Mr. Marcilla.
Thanks, Jimmy, and good day to the listeners and the viewers.
You're welcome. Well, this week saw the release of a couple of data from the Statistics Office, ranging from the manufacturing output, which fell by 16.3% year-on-year, to the business confidence, which recovered from a 35-year low in July, and the retail sales, which fell 7.5% year-on-year. And now the central bank sees a 32.6% drop in the second quarter GDP. For you, do you see a deeper recession in the second quarter?
Yes, definitely no, because all those sectors we just spoke about, they account for almost 26% of our economy. So if those sectors already are struggling, then it's a given that our GDP is not going to be looking okay. But even though we've seen some improvement, maybe starting with manufacturing, I mean, markets were expecting around 25%. It fell 16, but it's an improvement from the 2% fall that we've seen before. Same applies to our retail sales. At some point, they fell 11.9%, almost 12%. Then they just fell only 7.5%. So the fact here is that things are recovering, and for all common reasons, because we've seen that economy have started to reopen. If you look at the likes of April and May, I mean, especially April, our economy was closed, and that's the case for most economies globally, that they were closed, so things were not operational. But yeah, I think that's a number that one can easily say it's backward looking. The most important thing is going forward. Will we be able to recover? If we recover, to which levels, and how quick will we be able to do that? Because as you are saying, you're talking data that happened in June, in May, stuff like that. Yes, it's a bit concerning. It gives you a sense. I mean, for whatever reason, let's say maybe our GDP happens to contract by more than 10% in the second quarter. I mean, what's important here, is it the second quarter or is it the fourth quarter? I think we'll all agree that it will be the fourth quarter. And what are we doing to make sure that our fourth quarter looks much better? Because those circumstances that happen probably in the second quarter are definitely out of our control. And I think, Jimmy, we have to be honest, we're in a position that it's not only a particular country or a continent, it's a global thing. And we hope that the lawmakers, central bankers, business people will all use this opportunity to make sure that they clean up whatever that needs to be cleaned up, and so that they're well positioned to benefit the minute we start getting to the new normal.
Now, the Reserve Bank has long been under pressure to take more drastic measures to revive the economic growth, with calls for the bank to slash lending rates and finance government through quantitative easing. But then the Reserve Bank governor is not keen about widening the bank's mandate. How would you react to that?
I think we need to be careful here, especially if African countries, we try to be copycats of what the Europeans are doing, the Wall Street, the US is doing, because the guys are doing quantitative easing. Maybe we just need to understand one thing. The South African rand, just like most African currencies, as compared to your euros, your dollars, these currencies of ours are not held by anyone as part of their foreign reserves. No one is going out there to accumulate rands or the Nigerian lira as part of their reserves, unlike the euro and unlike the US dollar. So now you'll be in a situation that if you want to do quantitative easing, by the way, quantitative easing simply means you, as the Reserve Bank, you go and buy those bonds directly from the government. And we know that for any government to raise money, you issue bonds. But now what is happening is that there is the Treasury issue bonds, then the commercial banks, they buy the bonds, then the Reserve Bank comes and buy those bonds in the secondary market instead of them going directly to the National Treasury. And if they decide to go directly, definitely that will help to lower our borrowing costs. But now the Reserve Bank will be in a situation that probably they'll end up not having the necessary money. Yes, the repo rate will go down, but now thereafter, they have to go back as well and indirectly borrow money again from the very same National Treasury. And you tell me that, does that make sense? I don't think it does. And now, you don't even want to get into a situation where you get a central bank that's looking for a bailout itself from the National Treasury. Our interest rates, yes, they're at record lows. The guys managed to do that. And I think that's their way of trying to help the economy. And more importantly, the Reserve Bank has loosened some of the regulations for commercial banks to make it much easier for them to be able to lend out to the ultimate client. So that's something else. And they keep on participating in buying the bonds. We've seen, the bonds that they're holding now, they're more than 50% what they used to hold. So that's the little bit that they can do, because you also don't want to compromise the independence of your central bank. And it cannot only be monetary policy that helps the situation. You need that to work with the fiscal policy, and the fiscal policy, it means lawmakers must do their part. And also equally important, you need your social policies to be in place, or else then you'll get very few people benefiting from those fiscal and monetary policies. So I think we should learn to move away from having a fixation of the likes of quantitative easing because people are doing it. Maybe we need to start mapping out something, we'll call it whatever we want to call it, as long as it works for our particular situation. Let's move away from being copycats. Yes, we can learn from other people, but does not mean a formula that worked for Europe or US or Nigeria will work for South Africa or will work maybe for Ghana.
Right, thank you very much, Marcilla, for your thoughts there and for your contribution on our show. Thank you for your time. Marcilla is the Chief Investment Officer at Marque Fund Managers in South Africa. And oil prices were high on Friday morning and on track for a second week of gains amid growing confidence that demand for fuel is starting to pick up despite the coronavirus pandemic that has slammed economies worldwide. Brent crude was up 0.3% to $45.10 per barrel, while U.S. West Texas Intermediate also gained 0.3% to $42.35 per barrel. Prices have been bolstered this week by U.S. government data showing crude oil, gasoline, and distillate inventories all fell last week as refiners ramped up production and demand for oil products improved. And that's a wrap on the program for today and, of course, for the week. Thank you for being part of it. I'm Chimeze Obi Iwagu.